We're back with Leslie Preston. She's senior economist at TD Bank, and we are talking about the impact of potential U.S. tax package. You were talking about the likelihood, saying you think it's high, that something will happen. Whether that something is big or small or in between, we will wait and see. I wouldn't mind just talking about the specifics on what you see and the impact could be. And you brought a chart here to talk about the impact on GDP, but I wouldn't mind just dialing into understand some other parts of the sectors as well. But in terms of the specifics, what do you see the impact is going to be of a tax cut?
Well, some of the immediate impacts for consumers are that, on average, the U.S. consumer does get a tax cut. So you get a boost to consumer spending. Yeah. On the business side, you get a big reduction in corporate tax rates. You also have, businesses have the ability to fully expense investment in equipment to write it off right away. So we would expect to see a boost to business investment. Also, there's a repatriation tax holiday where companies can bring back money parked overseas at a lower tax rate, sort of as they did it before in 2005. That we would also see that potentially expect to boost dividend payouts and share buybacks by companies.
Which is a nice, again, investors' music
for investors,
to their ears.
yeah.
We've got a chart here that you brought in where you take a look at the GDP growth, and I'm assuming the one on the left is without, and the one on the right is a with. Is that correct?
Well, the one on the right is our forecast for 2018 and 19, and the bright green is what our current forecast is. So we're expecting about 2.3% growth in real terms next year in the U.S. economy. The current packages that are on the table now, we would expect to boost that growth by about 0.3 percentage points, so taking growth to 2.6. So as the chart of the title says, it's not a game changer for the U.S. economy. A lot of the Republicans are going around Washington talking about, we're going to drive growth of 3% over the long term. And we just don't see that happening in this package. You get a couple-year boost of a few tenths of a percentage point, but it's not a game changer.
Where are they getting that from? I guess that's just the politics of it all. So
yes,
yeah,
yes,
it's a big number. Okay, let's talk about some other impacts. If you take a look at what you see, U.S. dollar. Do you see? Is this going to have a huge impact on that?
Well, with the U.S. economy growing more rapidly, I mean, right now we're at arguably close to full employment. The Fed's already raising rates. They're in a rate tightening cycle. So we get faster growth. We're likely to get faster rate hikes, too. And that drives the value of the U.S. dollar relative to other currencies, drives it up. So you get a higher U.S. dollar, which ultimately actually increases the U.S. trade deficit, which is something that Trump says he does not want.
Yeah, which is the problem, I guess. You do the fiscal pieces, and then the monetary kicks in and tries to neutralize what you're actually doing. Housing.
Now, there are some elements of the package that could be negative for the housing sector in certain areas of the country. The House plan is going to cap the mortgage interest deduction, move it down from $1 million to $500,000, which will affect house prices in some more expensive markets on the coast where people have those mortgages larger than $500,000 or are trying to get. It would be on new mortgages. And also both plans look at either capping or repealing the state and local tax deduction. So that'll negatively impact taxpayers in high tax states, and it will indirectly affect the property market. So we've seen some estimates we're still working through where they talk about at the national level could affect house prices by 5%. But that would be more concentrated in the higher priced markets in places like New York and New Jersey that you could see a housing market impact.
Interesting. Markets you alluded to. I mean, the one thing, of course, if you give corporations more money, they're going to, the thought is investors would see more of that through dividends or share buybacks and those types of things. So do you see, is this market positive? Actually, let me ask it. Is it market positive from where the market is now? Because some of it's priced in right now, I guess.
Well, and that's the trick is how much is priced in? Because we certainly saw that Trump bump right after he was elected. How much of that was generally a Republican Washington, more business friendly, less regulation, all of that is priced in versus actual tax reform. So I think a smaller package could potentially have the potential to disappoint markets, and that we could see, if it's not as generous as Wall Street is hoping, that we could see a bit of a give back in terms or a bit more volatility on markets.
Which is interesting because there hasn't been a whole lot of give back in any market
It's a bit of debate to how much fiscal stimulus is priced in. So, if it's not fully priced in, you could see a boost when it comes through.
What about winners and losers? If you take a look at sectors and just from the economy standpoint, what's going to win out of this and what's going to lose?
Well, I think in terms, I already mentioned housing a little bit. In terms of things levered to consumer spending, people being able to spend more money, that would also be positively impacted. But it cuts so many different ways, because as you mentioned, we get higher interest rates. You would see declines in interest-sensitive sectors, also coming back to housing too, which could, further negatively impact the housing market.
Yeah. Let's bring up a second chart you have here about short-term gains and long-term pain, which of course politics doesn't really run on a long-term agenda. But if we can bring up that second chart, it shows here again you're paying for this in the long term.
Exactly. So what you see there is basically the last chart that was shown, but over a longer period. So the first 2 years, you see a boost to growth. And then in the out years of the plan, that goes out to 10 years, you see a drag. And there are a few reasons for that. Some of the measures in the tax package expire. That full expensing for businesses, which provides a boost to business investment, that expires after 5 years. So all that really does is pull forward spending businesses are doing. So then that gives back in the out years. They're also changing the way they're the inflation measure they're using, which reduces over time the benefit of the standard deduction and certain credits that are indexed to inflation. A less generous inflation measure reduces the value of those. And so the personal income tax cuts get less valuable, particularly for lower income households. And finally, part of that drag at the end is also because faster growth will induce the Fed to hike rates faster. And so then you get the drag from higher interest rates on the economy. So you've got a variety of forces essentially turning this plan into a drag in the out years.
Hi. Okay. It's fascinating actually to hear kind of what this means and what it may not be. Again, short-term gain, long-term pain. What does this mean for Canada? And I've only got about 45 seconds. But for someone who's watching this, what should we be thinking about? And let's layer in their NAFTA as well too, because that just gets a big old mess.
There's pluses and minuses to tax reform. I mean, Canada has a lower corporate income tax rate. We've enjoyed that advantage for quite a number of years now. So the U.S. cutting its corporate tax rates more competitive with Canada, so it does dull our competitive advantage there a little bit. But at the same time, if you get a boost to U.S. growth, that does still boost Canadian growth a bit. So we would see there would be positive spillovers on that side. But that said, in terms of risks out there for the Canadian economy right now, as you mentioned, I would see a NAFTA repeal as risks surrounding NAFTA as larger than the risks stemming from tax reform.
Fascinating. Leslie, thanks so much.
My pleasure.
Leslie Preston, Senior Economist at TD Bank.